Hello friends, welcome to Ria's classes. So in chapter 3 we already learned that all business transactions are first recorded in journal and they are posted in ledger accounts. Now think practically. If a business is very small, then maybe it can record all the transactions in one journal book. But what happens when the business grows? When the business expands, the number of transactions it increases. Every day there may be 50, 100, or even 500 transactions. So if we try to record everything in one single journal book, it becomes very difficult. It becomes time consuming, it becomes confusing, as well as it becomes bulky. So what is the solution for this? To make recording quick, efficient, as well as accurate, the journal is divided into special journals. So these special journals are meant for recording similar types of transactions. For example, all the cash transactions can be recorded in one book, all the credit purchases can be recorded in another book, all the credit sales can be recorded in another book. So these special journals are called as subsidiary books or day books. So why are they important? Because many transactions in business they are repetitive in nature. For example, we have daily cash sales, we have daily credit purchases, we have daily cash expenses. So instead of writing full journal entries again and again, we maintain separate books. So this basically saves time as well as it increases efficiency. So now in this chapter we'll study the special purpose books. We have the cash book, we have purchase book, we have purchase return book, sales return book, as well as journal proper. So all this we are going to study. So these are the important books of original entry after the general journal. So let's move to the cash book. So cash book is basically a book in which all the transactions relating to the cash receipts as well as cash payments are recorded. Okay, so it is very important that it records only the cash transactions. Okay, so if cash is received, it is recorded. If cash is paid, it is recorded. If it is a credit transaction, then it will not come here. So cash books, it starts with the opening balance of cash or bank. So generally it is prepared monthly. It is maintained by all the organization, whether it's big, whether it is small, whether it's profit making organization, whether it's non-profit or not for profit organization. So here is the most important feature. So cash book basically it serves the purpose of both of journal and ledger. Okay, so it is both a book of original entry as well as also a ledger account. So that means that when we maintain a cash book, we do not need to open a separate cash account, cash account in ledger because cash book itself is the cash account. Now we'll study the single column cash book. Okay, so single column cash book records all the cash transactions in a chronological order. Okay, so chronological order means date wise we are recording. So if the business deals only in cash and not in bank transactions, then we use single column cash book. So it has only one amount column on each side. So let's see, we on the left side we have the debit side and the right side it is called as the credit side. So left side will record all the receipts, the cash that is received, and on the right side, the credit side, all the payments are recorded, the cash paid. So let us understand this with an example. Suppose Messrs. Rupa Traders, they have opening cash of on 1st November rupees 30,000. Okay, so opening balance is always written on the debit side to balance brought down rupees 30,000. So why do we write debit side on debit side? Because we know cash is an asset, and whenever there's an increase in asset, it is debited. So this concept we have explained in third chapter. So if you are not seen the video, kindly go through the video, because you will not be able to understand some of the concepts that are being discussed in this chapter if you have not gone through that video. Okay, so next we have, next transaction is on November 4, cash received from Gurmeet 12,000. Okay, so cash is basically coming to business. So when the asset is increasing, we will debit it. So on the receipt side we will write to Gurmeet rupees 12,000. Okay, November 8 we have transaction cash insurance paid rupees 6,000. So this we'll write on the credit side by insurance by insurance rupees 6,000. Okay, so why are we writing on the credit side? Because cash is decreasing, cash is going out. Cash is an asset. Whenever there's a decrease in asset, we write it on the credit side. Okay, and also insurance is an expense, so we are basically debiting it. Now we have purchased furniture for rupees 13,800. So when we are purchasing furniture, the entry is cash account debit to furniture. So whenever sorry, we are purchasing na, furniture account debit to cash, because when we are purchasing furniture, so furniture is an asset is increasing, so we'll debit it, and cash is an asset, it is decreasing, so we will credit it. So on the credit side of cash book we'll write by furniture account 13,800. So similarly many other transactions can be recorded. So at the end of the month we'll balance the cash book, add both sides. Okay, so whatever the difference is, it is written as balance carried forward on the smaller side, and next month it becomes balance brought down. So important rule here is that cash book always has a debit balance, because cash in hand it can never be negative. Okay, now talking about posting of single column cash book. So remember that cash book itself is a cash account, so we do not need to open any separate cash account in ledger. So how do we post it? So entries on the debit side of cash book, they are posted to the credit side of the respective ledger accounts. For example, we had written cash received from Gurmeet rupees 12,000. So in the cash book we had written it on the debit side to Gurmeet, because Gurmeet has paid cash, so his liability has basically reduced. So we credit him by cash. This is the cash account. Okay. Now similarly, insurance paid we had written in cash book. We had written by insurance 6,000, and in insurance account we had written to cash. Okay. So all this we have discussed. This is how basically posting is done. So all accounts like sales account, insurance account, furniture account, purchase account, stationery account, rent account, they are posted basically from this cash book. Now we'll move towards double column cash book. So nowadays we know bank transactions are very large. So businesses did not keep all the money in cash. They open current account in bank. So bank does not give interest on current account, but it charges small amount called as incidental charges, so bank charges. When cash or check is deposited in bank, we fill a paying slip. So bank gives checkbook for it gives us a checkbook for withdrawing money. So check types, there are various types of checks. We have the bearer check, okay, order check, cross check. So bearer check basically when the payment is made to a person, bearer check when payment is made to a person who is holding the holding the check. Order check is when payment is made to person named or his order. Okay. Cross check is cross check is it cannot it cannot be encashed directly, but it must be deposited in bank. Cross check. Account pay check we also have. In account pay crossing, amount is deposited only in account of named person. So now in double column cash book we maintain two columns on each side. We have the cash column as well as we have the bank column. We have cash column as well as we have the bank column. So left side is basically a cash received and right side is basically the cash which has been paid. Or it can be check issued also, and here we cash received as well as in bank whenever deposit is made. So when cash is deposited in bank, so basically what is happening, cash is decreasing and bank is increasing. Okay. And so both are recorded in cash book itself. So bank column debit side, cash column credit side. So mark it with C. So these are not posted to ledger because both cash and bank are already in cash book. Okay. So when check is received and if it is deposited in the same day, then we'll record it in bank column. If it is deposited later, then on date of receipt it is recorded in cash column. So on the date of deposit, we'll do a contra entry. In case of dishonor of check, means if a check is returned unpaid, entry made on credit side of bank column. Okay, this we have made, na? Okay, entry made on credit side, entry made on credit side of bank column, and customer name is written. In case of bank charges, okay, we'll write it in the credit side of bank column. Okay, because bank charges, what is happening? A bank our balance is reducing, no, because of the charges. So any reduction in the asset is written on the credit side. Okay, overdraft, when the bank column has credit balance, meaning the business owes to the bank. Now let us look at an example. Messrs Tools India. Okay, it has a opening cash. Messrs Tools India, it has opening cash of rupees 15,000. It has bank balance of 42,000. Okay, and all the transactions are recorded accordingly. So at the end, balance is calculated for both the cash as well as bank column. Okay, so let us look at here. Bank balance 42,000. So this is the basically the opening balance. So September 1 balance brought down. How much is the cash balance? We have 15,000 here, so we recorded here, and bank balance is 42,000. Okay, so this we have done. This then we have purchase goods by check. Okay, so we are purchasing the goods by check. So basically our bank balance is reducing. When it is reducing, we'll write it on the credit side. So we'll write by purchases, bank will reduce by 12,000. Sales of goods for cash. When we are selling the goods, cash is coming, so cash is debited. So by two sales, so cash is increasing by 6,000. Next we have purchase machinery by check. Machinery is coming, machinery debit to bank since we are purchasing by check. So on the credit side, we'll write by machine 5,500. Sold goods and received check deposited the same day, rupees 4,500. So we have deposited check. So entry is bank account debit to sales. So on the debit side, we'll write to sales 4,500. Purchase goods from Riola in cash. Okay, so cash we are purchasing the goods 70,400. Okay, so the entry is purchase account debit to cash. Cash is decreasing, so it is credited. So we have written it here on the credit side. Purchase stationery by check. Bank balance is reducing. Stationery is an expense. Debit all expenses. Okay, so we have written here. Sorry, we have written here the credit side. Check given to Rohit, rupees 1,500. So check where and when we are giving. So our bank balance is reducing, so we'll write it here. Cash withdrawn from bank 10,000. So cash is basically reducing. This is contra entry. Cash is reducing 10,000. Bank balance is increasing. So this is a contra entry. Note this. Okay, then rent paid by check. Rent account debit. Rent is an expense. Debit all expenses. To cash. Our asset is reducing. So credit side. So rent paid by okay, not cash. So bank is reducing. So by rent 2,500. Last we have paid salary. Salary is an expense. Salary account debit to bank. To cash. It's written in cash we are paying. So basically we'll total all these things. Okay. So cash balance. So basically the debit side total is greater than the credit side total. So on the smaller side, the balance carried down will be written both for cash as well as bank. So after we have made the cash book, we'll post it to all the respective accounts like purchase account, sales account, machinery, stationery, all the accounts that we have discussed in this example. Okay, so we'll now continue with the discussion of petty cash book. So petty cash book is used to record small cash payments. Okay, so the word petty it means small. So large payments they are recorded in main cash book, whereas small payments are recorded in petty cash book. So this system basically reduces the burden on the main cashier. So there are two systems of maintaining petty cash book. One we have the ordinary system, then we have the impress system. So this impress system is more commonly used and it is more important for exams. So let us understand the impress system carefully. So under this system, a fixed amount of money is given to the petty cashier at the beginning of a period. So this fixed amount is called as the impressed amount. For example, at the beginning of a month, petty cashier is given rupees 5,000. So during this month, he spends money on small expenses. Suppose he spends rupees 4,200 during the month. So at the end of the month, the main cashier will reimburse rupees 4,200. So again, total cash in hand becomes rupees 5,000. So this fixed amount is always remains. So this system basically it ensures control, accountability, accuracy, and prevention of fraud. Now let us understand format of petty cash book. Okay, so it has a date column, it has a particulars column, it has voucher number column, it has total amount column, as well as analysis columns for different types of expenses. For example, the expenses can be like for postage, for conveyance, for stationery, for printing, as well as for miscellaneous items. Now, why do we have basically separate accounts? Okay, so because at the end of the month, we can easily total each column and know how much amount was spent for each type of expense. So, this basically saves time when we are posting to ledger. Now, let us see how this posting is done. So, basically, the total of each expense column is posted to the respective expense account in ledger. For example, we have total postage rupees 1200. So basically, when we make postage account, we know postage is an expense. Whenever an expense increases, it is debited. So the postage account will be debited, like if payment is made in cash. So postage, it will be debited by 1200. Okay, then petty cash account is credited with the total expenses. So thus the petty cash book works as both it works as original entry and ledger for petty cash book. So let us see this petty cash book that has been prepared in the books of Samara traders. We have this amount received. We have received this 2000 amount. Okay, and these are the list of the expenses that are being made. Okay, so here we have received cash, okay, at the beginning of month, and after that various expenses are made like for auto fare, courier services, postal stamps, stationery items. We have postage expense, taxi fare, refreshment, auto fare, instant post, again stationery, STD call charges. So all these small expenses have been made. So they have been categorized separately. Like for postage, we have written here, telegram, we have written here, conveyance, stationery, and miscellaneous items we have classified here. And balance carry forward is being recorded here. And the next month, the balance brought down is here, and cash will receive the balance amount, like 2000 minus this 513. So what are the accounts that we are recording? The entries that we are recording. Petty cash account will debit to cash account because the main cash account we are transferring it to this another account, petty cash account. And from this cash account, we are debiting all the expenses. So basically, it is not affecting our main cash account. So all the expenses are debited, and since petty cash is an asset, when asset reduces, it is credited. Then whenever cash is paid once again, then petty cash account debit to cash. So basically this is posted, petty cash is debited here. So here we'll write to cash account 2000, and when sundry expenses we'll record here balance carried down. So and these expenses that I had mentioned, these conveyance, postage, stationery, all the expenses are debited here. So to the respective accounts we will post it. Now moving on to balancing of cash book, let us go through these examples. From the following transactions made by Kuntia traders, prepare the single column cash book. Okay, in this we have details given. First of all, cash in hand 40,000. So this is basically the balance brought down. So we'll debit it by 40,000, deposited in bank. So what is happening basically? Cash account, it is our asset. Whenever this will increase, it will be debited, and whenever it will decrease, so it will be credited. Whenever an asset increase. Okay, so whenever we are depositing in bank, so what is happening? Our cash is reducing. So deposited in bank, it will be cash account will be credited. So by bank account rupees 16,000. Received from Puneet in full settlement of claim. So we are receiving it. We are receiving the amount. So basically 11,700. So we'll record it here because the cash is increasing. So it will be debited to Puneet 11,700. Cash paid to Rukmani in full settlement of claim. So cash is going out. So decrease in asset, it will be credited. Rukmani to Rukmani 6850. Sold goods to Sudhir for cash. When we are selling the goods, cash is coming. So it will be debited to sales. Paid quarterly insurance premium for proprietor's wife. So cash is going out. So it will be credited. Okay. This we have to remember, it is for proprietor's wife, so this is basically a personal expense of the proprietor. It is not a business expense. So whenever cash is withdrawn for personal use, so it is basically a drawings. It is reduction in capital. So we will write drawings 2740. Then purchased office furniture, the cash is reducing. So 8,000 rupees office furniture to debit. Purchase stationery, stationery is an expense, debit, cash credit. So 1,700 we'll write here. Paid cartage, similarly, similar expense only. Paid Kamal discount allowed by him, rupees 200. So discount is allowed 200, okay, but we are paying 6,800. So we have to just record the amount that we have paid. Received from Gurmeet, discount allowed to him 500, 14,500. We have received 14,500, so we'll write to Gurmeet. So who is Gurmeet? Gurmeet is basically our debtor. So whenever debtor decreases, it's an asset is decreasing. So to Gurmeet, we'll credit, and cash we are receiving. So the asset is increasing, so we'll debit it. Then we have paid postal charges, similar only, monthly rent, all these are expense. So this will be recorded on the credit side. Read the following transactions in double column cash book and balance it. Okay, we have cash balance, bank balance, paid insurance premium, cash sales discount. Okay, so let's first of all we'll make this cash book. We'll enter make this. We have two sides, debit side as well as credit side. We'll write the date, receipts, ledger folio, cash bank, date, payment, ledger folio, cash bank. Okay, so first of all, we'll carry forward the balances. So balance brought down. Okay, what is it? Here we have cash balance rupees 15,000, bank balance rupees 10,000. Okay, so we have written this. Then the second transaction, we have paid insurance premium by check. So basically, bank account is being affected. So bank is reducing, so we'll mention it on the credit side. So buy insurance 4,200. Next we have cash sales. Cash sales is cash is increasing. So basically we'll write it on the debit side. Cash sales 22,000. Then we have cash discount. Cash discount, it's not to be recorded because it does not involve any cash or bank. Payment for cash purchases. Payment we are making, this will be recorded on the credit side of cash book. Cash deposited in bank, this is important, 15,000. So when we are depositing cash, bank balance is increasing, so it will be written on the debit side, and C we will write showing that it is a contra entry. And on the credit side, we'll write to bank 15,000 because cash is decreasing. So it will be mentioned on the credit side. Then we have telephone bill paid by check. This is easy. Telephone bill is an expense. So whenever bank balance is reducing, to telephone we'll write telephone expense. Bank on the credit side will show. Withdrawn from bank for personal use. When we are withdrawing for personal use, Drawings will be debited to bank. Bank is credited because the asset is reducing. So on the credit side, we'll write to drawings 6,000. So this is basically all conceptual thing. If you understand the logic behind it, it's these entries are very easy. Okay. So withdrawn from received a check from John in full settlement and deposited the same in bank 10,700. So basically it is nothing but your bank balance is increasing. You have deposited. So to John 10,700. So who is John? John is basically our debtor. Okay. Received cash from Michael 6850. This discount allowed us just to confuse you. Actually, we have to see how much cash we have received and we have to record that only in cash book. So 6850 to Michael, we'll record it here. Then we have stationery based purchase for cash. This is simple. This is just an expense. So on the debit side of cash book, we'll write it here. Sorry, no, on the credit side, all these expenses will come. Printing stationery, rent, wages, postage. On the credit side, it will come. Okay, check received from Kumar deposited in bank also. The bank balance is going to increase. Bank is going to increase. On the debit side, will show 4,500. Okay, here we have check received from Kumar. Okay. Then we have rent paid by check, paid wages to watchman in cash, paid cash for postage. So all this in credit side we will record. And whatever balance is coming, why is this balance coming? Because the debit side is greater than, when the debit side is greater, total of, when the total of debit side is greater than the total of credit side, then balance carry forward, it will be on the credit side. This will be carry forward here, the next month opening. Okay. Now we'll move forward to purchases account, purchases book. Okay, so purchase book is used to record only the credit purchase of goods. So very important thing is it records only the credit purchases of goods which is meant for resale. It does not record any cash purchase, purchase of assets like furniture or machinery, purchase of goods for personal use. So if the furniture is purchased on credit, it will not go to purchase book, it will go to journal proper. So why only goods for resale? Because purchase book is meant to record trading purchases. Okay. Now format of purchase book is, first of all we have invoice number, we have name of supplier, we have details as well as ledger folio. So whenever goods are purchased on credit, entry is recorded in this purchase book. So at the end of the period, total of purchase book is debited to purchases account. Okay. Individual suppliers accounts are credited. So let's understand this logic. If the goods are purchased on credit, we know the purchases increases. So basically it will be debited, and creditors increase. So supplier increases. So it will be credited. So instead of writing the journal entry every time, we'll simply record it in the purchase book. Next, we have the purchase return book. Purchase return book is also called as the return outward book. So sometimes goods purchased are returned to the supplier. So reason for for return can be either the goods are defective, or we have received the wrong goods, or we have received excess quantity, or we have received damaged goods. So such returns are recorded in purchase return books. It records only the credit purchase returns. So format is similar to the purchase book. The total of purchase return book is credited to purchase return account. So in this, the individual supplier's accounts are debited because liability towards supplier decreases. Next, we have the debit note as well as credit note. Okay, so what is debit note? Debit note is basically a document which is prepared by a buyer to inform the seller that the seller's account has been debited. In simple words, when we return goods to supplier or when we want to claim extra amount from a party, we prepare a debit note. So it is called debit note because we are debiting the supplier's account. So when is debit note issued? First of all, when the goods are returned to supplier. When will the goods be returned to supplier? If it is not as per order, if it is defective, if it is damaged, or if it is in wrong quantity. So then goods are returned to the supplier. Now since the supplier owes us the value of returned goods, so we debit his account. So we issue a debit note. Then second reason may be additional amount. Additional amount is recoverable. So if some extra amount is recoverable from a customer, we prepare a debit note to debit the customer's account. For example, suppose undercharged earlier. Now extra rupees 1000 is to be collected. Then we issue debit note. Example, suppose you purchase goods worth rupees 10,000 from Ram Traders on credit. So later you return the goods worth rupees 2000. Now what happened? So Ram Traders liability has basically reduced by rupees 2000. So entry would be Ram Traders debit because liability is decreasing, so it will be debited to purchase return account. And you will issue a debit note of rupees 2000 to Ram Traders. Okay, so specimen of debit note has been shown here in this figure 4.7b. So basically it contains the name of the firm which is issuing the debit note. Then we have the address of the firm, the date, debit note number. We have the supplier's name also, and delivery challan number, details of goods returned, amount, signature of manager. So this basically it serves as a documentary evidence. Similarly, we have format of uh, credit note also. So credit note is basically a document which is issued by a seller to a buyer informing that the buyer's account has been credited. So in simple words, when goods are returned by a customer, we issue a credit note to that customer because we are crediting the customer's account. So when is a credit note issued? Okay, so whenever goods are returned by customer, whenever excess amount charged earlier, some allowances given. So the seller basically prepares a credit note. So the page mentions that the credit note is commonly made in red ink. Why red ink? Because it reduces the amount receivable. It indicates reduction in sales value. For example, you sold goods worth rupees 15,000 to Mohan. So later Mohan returned the goods worth rupees 3,000. Now what happens? Mohan's account must be reduced by rupees 3,000. So entry would be sales return debit to Mohan. Mohan is our debtor. Debtor is an asset. Whenever asset reduces, we will credit it. Okay, so we'll credit Mohan's account. So we'll issue a credit note of rupees 3,000 to Mohan. And we have As it's this is similar to debit note also. The format, name of issuing, uh, name of the firm issuing the note will write address, date of issue, amount, customer's name, goods returned by customer, challan number, details of goods, amount, signature. Now let us understand the difference between the two. Okay, so let us see. We'll make a chart. Basis we'll write. We have debit note as well as we have credit note. Okay, so first of all, let's see. It is issued by buyer. Debit note. Credit note is issued by seller. It is used for it is used for purchase return debit note, whereas this is used for sales return. Okay, let us see the effect in this. The supplier debited, whereas in this the customer is credited. Then we have the accounts affected purchase return, whereas in this we have the sales return. So easy trick is basically whenever the goods are coming back to you, then issue a credit note. If the goods are going back from you, then issue debit note, or simply purchase return equal to debit note, sales return equal to credit note. So why is this important? Because it serves as a documentary proof. They help in maintaining the correct accounts. They help to reduce the disputes as well as they support the entries in purchase return book and sales return book. Okay, so now we'll begin with the topic sales book, which is one of the most important subsidiary books in accounting. Until now, we have studied purchase book and purchase return book. Now, we'll logically, the next step is to understand sales book. So, let us understand what sales book is. Sales book is basically a special purpose book. It's a special purpose book which is used to record only the credit sales of goods. So, this point is extremely important because it records only sale of goods and only credit sales. It does not record cash sales. It does not record any sale of assets like furniture or machinery. It does not record any non trading items. So ask yourself, why only credit sales? Because cash sales we know are already recorded in the cash book. So at sale of assets, it's not a regular trading activity. So it's a capital transaction. So such entries are recorded in journal proper. So sales book is basically meant only for recording credit sale of goods that the business normally deals in. Now let us understand the format of sales book. So the sales book contains the following columns. We have the date, we have invoice number, we have name of customer, as well as ledger folio, details and amount. So let us understand each column carefully. So date basically it records the date of transaction. Invoice number column records the sales invoice number. So this basically helps in cross checking. Name of customer records the name of the debtor. Ledger folio column is basically used at the time of posting to ledger. So it indicates the page number of ledger account. Then we have detail column describes the details of the goods we mention, as well as quantity rate description can be there. And amount column, it records the net amount after deducting trade discount. Now let us understand how the entries are recorded in sales book. Okay, so first of all, let's see this example. For example, Mrs. Koina supplies sold on credit 2 water purifiers at the rate of 2100 each and 5 buckets at the rate of 130 each to Messrs. Raman Traders. Invoice number has been written, dated 178 April, and this one. So we'll make this sales book. Okay. So we'll write this first transaction, invoice number April 6, invoice number 178 Raman Traders. We'll write this amount 4850. So how did we arrive at this? We have two water purifiers. We have two water purifiers, 2100 each. So 2100, 2100. We have 4200. Then we had uh, 5 buckets of 130 each. So 130 into 5, we have 650. So we'll add both of them. We have 480, 4850, 4850. So we'll record this here. Customer is Raman Traders. 5 roadside containers at the rate of 4200 each were sold to Messrs. Newton Enterprise, invoice number. So we'll write the customer name here. We'll write the invoice number 21,000, 4200 into 5. We have 21,000. Similarly, we sold 100 big buckets at the rate of 850 each to Messrs. Raman Traders. So we'll record this here. Let us understand posting from the sales book. So at the end of the period, say monthly, basically the total of sales book is credited to the sales account. Why is it credited? Why credited? Because we know sales is income, and any increase in income is credited. And why are the individual accounts debited? Individual accounts are debited because customer has become our debtor. And whenever an asset or debtor increases, that will be debited. So posting processes the total sales, credit sales account, and individual entries will debit the respective customer account, like we have done here. We have debited here, and sales we have credited. Okay, so one important thing to note is, let us understand the difference between sales book and sales account. Sales book is basically a book of original entry, whereas sales account is a ledger account. So it records the transaction first, it shows the total effect. So this difference is basically very important in exams, don't get confused. Now let us understand what is not recorded in sales book. We know cash sales. Cash sales is not recorded because cash sales are recorded in cash book. We do not record sale of assets as discussed earlier, and because it is recorded in journal proper as well as services provided. If a business provides services instead of goods, it may be recorded in journal or separate register. So sales book is strictly for for credit sale of goods meant for resale. Now one more important concept is trade discount. Trade discount. So trade discount is basically the reduction in price which is given to customer at the time of sale. So this is not recorded in books. This is very important. It is deducted before the entry. But cash discount is different. Cash discount, this cash discount, it is given at the time of payment, and thus it is recorded in cash book. So students often confuse between trade discount and cash discount. Remember that trade discount, it is not recorded, whereas cash discount is recorded. Now let us summarize. When credit sale happens, we have to record in sales book. Step 2, at the end of the period, the total is credited to sales account. Step 3, the individual accounts are debited. So thus the sales increase. Whenever the sales increase, it will be credited. The debtors would increase, thus it would be debited. So this follows the debit and credit rules perfectly. So now we have conceptually understood why sales book is needed. So imagine a large business doing 500 credit sales per day. So if all are recorded in journal, then journal will become huge, posting will become slow, risk of errors will increase. So by maintaining the sales book, the recording has become simple, work has been divided, posting has become easy, as well as internal control also improves. So this is why subsidiary books are very important. Next, we'll move towards the final subsidiary book of this chapter, which is called as Journal Proper. So, until now, we have studied several special purpose books, such as we have cash book, we have purchase book, we have purchase return book, we have sales book, as well as we have sales return book. So, each of these books basically records specific types of transactions. But now, think logically: is it possible that every transaction in business can fit into these books? The answer is no. So there are certain transactions which do not belong to any of the subsidiary books, and such transactions are recorded in journal proper. So journal proper is basically the residual book of original entry. It is called as residual book because it records all those transactions which cannot be recorded in any other special book. So, in simple words, whenever a transaction does not fit anywhere else, it comes in journal proper. Now, let us understand what type of transactions are recorded in journal proper. The first category is opening entries. Okay, so opening entries basically at the end of a new accounting year, the business has certain assets as well as liabilities. So these balances are brought forward from the previous year. So to bring these balances into the new books, we pass an opening journal entry. For example, suppose at the beginning of the year we have cash of rupees 20,000, we have furniture rupees 50,000, we have stock worth rupees 30,000, as well as we have creditors worth rupees 25,000. So we need to record these in the new book. So the entry would be cash account debit 20,000, furniture account debit 50,000, stock account debit rupees 30,000, to creditors and to capital, which would be the balancing figure. The second entry is closing entry. So at the end of the accounting period, all the nominal accounts such as expenses as well as revenues must be closed. So they are transferred to trading account or profit and loss account. For example, sales account debit to trading account or trading account debit to purchases. So such transfer entries are recorded in journal proper. Third category we have is transfer entries. So sometimes the amount is transferred from one account to another. For example, if salary expense is mistakenly recorded as wages account and it is later on corrected, then the transfer entry is passed. So these adjustment or correction entries, they are recorded in journal proper. Fourth category is adjustment entries. So at the end of the accounting period, certain adjustments are required, such as outstanding expense, we have prepaid expense, we have accrued income, as well as we have depreciation. For example, we have salary outstanding rupees 5,000. So salary, so we'll write salary account debit 5,000 to outstanding salary account 5,000. So these entries are not recorded in subsidiary books, they are recorded in journal proper. Fifth category we have is rectification entries. So in so let us see the importance of journal proper. First of all, it ensures that no transactions no transactions remain unrecorded. It a- o- it acts as a supporting book for special cases. It helps in recording the adjustment entries, which are extremely important for preparing the final accounts. So without journal proper, it would not be possible to record the opening balances, it would not be possible to record the closing transfers, the adjustments, as well as the rectifications. So basically, journal proper completes the system of subsidiary books. S- So let us now discuss the logical flow of the entire the topic that you have studied. So earlier, all the transactions were recorded in one journal. To save time and improve efficiency, the journal was divided into special books, which is cash book, petty cash book, purchase book, purchase return book, sales book, and sales return, and finally the journal proper. So together, these books are called the books of original entry. All these transactions are first recorded in any of these books, and then it is posted to ledger. Then the trial balance is prepared. Then final accounts are prepared. So this journal proper plays a very crucial role in completing the accounting system. So at this stage you have understood that it is used for transactions not covered by any other subsidiary books. It follows the same format as journal and it ensures completeness of accounting records. Now let's discuss these questions. When a firm maintains a cash book, it does not maintain. Okay, so options are journal proper, purchase journal book, sales journal book, bank and cash account in the ledger. Answer is fourth option, bank and cash account is in ledger. So we know that cash book basically it serves two purpose. It is a book of original entry and it is also a ledger account for cash and bank in case of double column. So therefore, when cash book is maintained separate, cash account as well as bank account is not required in the ledger. However, proper is still required. Purchase book and sales books are still required. Next, we have double column cash book records all transactions, cash and bank transactions, only cash transactions, or only credit transactions. Answer is cash and bank transactions. Okay. So double column cash book basically has one column for cash, another column for bank. So it records cash received as well as paid and bank receipts and payments. It does not record credit transactions. Therefore, the correct answer is cash and bank transactions. Next question we have goods purchased on cash are recorded in purchase journal book, sales book, cash book, or purchase return book. The answer is cash book. Why? Because purchase book we know it records only the credit purchases of the goods. Cash purchases are recorded in the cash book because money is paid immediately. So if goods are purchased for cash, the entry would be purchase account, purchase account debit to cash account. So this entry is recorded through cash book. Next question we have cash book does not record transaction of cash nature, credit nature, cash and credit nature, or none of these. The answer would be credit nature. So we know that cash book only records cash received, cash received, cash received, cash paid, Bank transaction, if it is double column, so it does not record any credit transactions. Example, if goods are sold on credit, then it is recorded in sales book, and if the goods are purchased on credit, it will be recorded in purchase book. So since no cash is involved, such transactions are not entered in cash book. Next question we have, total of these transactions is posted in purchase account. The answer would be cash and credit purchases. Okay, why? Because purchase account records all purchases of the goods which is meant for resale. So it includes cash purchase as well as it includes credit purchase. Cash purchase, it is posted from cash book, and credit purchase is posted from purchase book. When we say purchase of furniture, it is not recorded. Uh, so purchase of furniture, it is recorded in furniture asset account, is not purchases account, not recorded in purchases account. Purchases return, it is recorded in purchases return account. Separate account is maintained. For when we are doing purchase of stationery, is an expense, it is recorded in stationery account. So the total purchases cash and credit, it will go to purchases account. Next we have the periodic total of sales return journal is posted to. The answer is sales return account. Okay. So sales return journal basically it records the goods which is returned by customers. So the end of the period, the total is debited to sales return account and individual customers are credited. Now why debit sales return? Because sales return reduces the income and decrease in income is debited. So it is not posted to the sales account directly. Next we have credit balance of bank account in cash book. It shows answer is overdraft. Okay, so normally bank column it shows debit balance, that is a positive bank balance. If credit side is more than the debit side, it means that we have withdrawn more than we have deposited. So this situation is called as bank overdraft. So overdraft means bank has given us extra money or it has given us loan facility. So credit balance in bank column equal to overdraft. Next we have the periodic total of purchase return journals is posted to. What would be the answer? The answer would be purchase return account. Why? So purchase return journal basically records goods which is returned to suppliers. So at the end of the period, the total is credited to purchase return account and individual suppliers are debited. Why credit? Because the purchase return reduces the purchases and decrease in expenses credited. Now let us understand the next topic, balancing of accounts. Okay, so balancing basically means finding the difference between total of debit side and total of credit side. So if debit is greater than credit, then we would have debit balance. If credit is greater than debit, then we will have credit balance. So basically this difference is called as balance carry forward, and then it is brought down as balance brought down. So balancing does not mean just totaling one side. As we come to the end of this chapter, let us quickly reflect on everything we have learned. Okay, so this chapter on recording of transactions too has taken us from basic journal recording to a more practical and organized system of accounting through subsidiary books. Okay, so we begin by understanding why a single journal entry, single journal becomes insufficient when business transactions increase. To overcome this difficulty, the journal is divided into special purpose books, which are also called as subsidiary books. So, this division basically helps in saving time, reducing errors, and allowing division of labor. We studied the cash book, which is a unique which is unique because it serves both as book of original entry as well as a ledger account. So we learned about single column cash book, double column, and the important concepts like contra entries and bank overdraft. We also understood about petty cash book, especially the impress system, which ensures control over small expenses and it improves internal efficiency. After that, we discussed about purchase book, about sales book, which records only the credit purchases as well as the credit sales of goods, which is meant for resale. We clearly differentiated between cash as well as credit transactions and understood about trade discount, which is not recorded in books. We also studied about purchase return book as well as sales return book, along with the importance of debit notes as well as credit notes as documentary evidence. Finally, we understood finally we understood the role of journal proper, which records all those transactions that do not fit into any other subsidiary books, such as opening entries, adjustment entries, rectification entries, and transfer entries. So, through this chapter, one important idea remains constant. Proper classification and systematic recording ensures accuracy in accounting. So, each transaction must first be recorded in the appropriate books of original entry, and then it is posted to ledger. So this structured system forms the foundation for preparing trial balance and final accounts. So if your basics of subsidiary books are clear, then the rest of the accounting becomes much easier as well as more logical. So always remember, good accounting is not about memorizing entries, it's about understanding classification and flow. So if this detailed explanation helped you understand the chapter clearly, don't forget to like this video, share it with your friends, and subscribe to Ria's classes for more concept based and in depth accountancy learning. Keep practicing, keep revising, and I'll see you in the next chapter. Bye bye.